Most people only focus on ARK's recent performance swings. What they miss is this. Cathie Wood has just delivered the most aggressive and comprehensive macro call of her career in her latest 2026 investor letter. She uses a striking phrase to describe the next 3 years: Reaganomics on steroids. What does she mean by that? In short, Wood believes the U.S. economy has been pushed to its limits and is now set up for a powerful release. First, her core argument, the US hasn't truly been strong beneath the surface. Yes, headline GDP kept growing over the past 3 years, but the real economy has been in a rolling recession. Housing, manufacturing, traditional capex and middle to lower income consumers were all crushed by the fastest rate hiking cycle in modern history. This wasn't expansion, it was compression. And in her words, the spring is now fully coiled. Second, policy is shifting in a structural way. Deregulation, lower effective taxes, accelerated depreciation, and incentives for domestic manufacturing, combined with the simultaneous maturity of AI, robotics, energy storage, and blockchain. Wood's view is that the US is replaying a hybrid of 1980s Reaganomics and the 1990s tech revolution at the same time. One key detail matters here. Corporate effective tax rates could move toward 10%, turning capital spending from a cyclical peak into a long-term floor. Third, her inflation thesis is where it gets controversial. Wood explicitly argues something most investors still struggle to accept. Inflation may continue, falling in could even turn negative. Not because demand collapses, but because productivity explodes. AI training costs are falling roughly 75% per year. Inference costs are dropping closer to 99%. Technology is directly compressing unit labor costs. In her framework, future US nominal GDP growth of 6 to 8% comes almost entirely from productivity, not inflation. Fourth, asset performance will sharply diverge if US investment returns once again dominate globally. Wood believes the dollar could enter a cycle similar to the 1980s, potentially doubling, and that has consequences. It suggests gold's macro tailwind is fading, not necessarily an immediate collapse, but the environment that fueled the rally is weakening. Bitcoin, however, is different. Its fixed supply and low correlation mean it may behave very differently from gold in a strong dollar regime. Fifth, on the AI bubble question, Wood is unequivocal. This is not a bubble yet, valuations are high, but if productivity gains materialize, earnings growth can absorb them. Markets can deliver positive returns even as multiples compress, just like the mid to late 1990s tech cycle. Her real message boils down to one line. If you're only watching valuations, you risk missing a productivity-driven regime shift. This isn't a short-term trading call. It's a long-duration bet on policy, technology, and capital structure. You don't have to agree with her, but you do have to admit this is one of the most internally consistent macro narratives we've seen in years, and in the end, the market will decide.